As per one of the World Gold Council report, Indians hold around 24,000 tons of gold. If you multiply it with current price of around 40,000 rupees per 10 grams, it will be equal to around rupees 90 lakh crores. Do you know this is close to half of India's GDP for the year 2018-19? This is close to 3.5 times the total assets of mutual funds and 2.5 times the insurance industry AUM. Such is the value of gold lying idle with households. Therefore, in order to bring such gold in the financial system, the government launched a scheme called Gold Monetization Scheme in 2015. Hi, I'm Renu Yadav from Mint's personal finance team, and in today's episode of Why Not Mint Money, we are going to talk about Gold Monetization Scheme. Let's first understand what is Gold Monetization Scheme. This scheme basically allows you to earn interest on the gold that you deposit under the scheme. Let's understand how you can register under the scheme and the other features of this scheme. First of all, you need to get your gold holdings evaluated at the collection and purity testing centers. These are BIS certified purity testing centers which will issue you a certificate of purity of the gold after testing it. Remember, the assaying center will melt the gold. Therefore, you should only deposit the gold which you don't want to use in the current form. You can deposit the gold with the collection and purity testing center and take a certificate acknowledging the receipt of deposit. Then you can take the certificate to any of the designated bank's branch and open a deposit account under the scheme. If you already have an account with the bank, you don't need to open a new account. The bank will open an account with a deposit amount equal to what is mentioned in the certificate issued by the Purity Testing Center. For calculating the value of gold, the prevailing market price will be considered. The minimum amount of gold that you can deposit under the scheme is 30 grams. The gold should be of 99.5% purity, while there is no upper limit on the gold that you can deposit under the scheme. There are two types of deposit that you can make under the scheme, that is short-term and medium and long-term deposits. The short-term deposit will have a tenure of 1 to 3 years. You can deposit the sum for a broken period, that is, for example, 2 years, 3 months or 1 year, 2 months. Under the short-term deposits, banks are free to decide the interest rates as per RBI regulations because the liability of paying interest lies with the bank. Currently, SBI is offering an interest of 0.5% per annum for a deposit of 1 year, 0.55% for a deposit of more than 1 year but up to 2 years, while the interest on the deposit between 2 to 3 years is 0.6%. You are allowed to make premature withdrawals under the short-term deposits. You can take the maturity proceeds in the form of gold or cash. You need to mention the same while applying for the scheme. Now let's talk about the medium and long-term deposits. The medium-term deposit can be made for a period of 5 to 7 years, while the long-term deposits can be made for a tenure of 12 to 15 years. These deposits are accepted by banks on the behalf of central government. Therefore, the interest rate on these deposits is decided by the central government and notified from time to time. Currently, the interest rate on medium-term deposits is 2.25%, while the interest rate on long-term deposits is 2.5%. Premature withdrawals are possible in case of medium-term deposits after 3 years, while in case of long-term deposits, you can withdraw your money after 5 years. However, you will have to pay a penalty in case you opt for premature withdrawals. It will be in the range of 0.25% to 0.375% depending on the time at which you withdraw. Basically, your proceeds will be equal to the market value of gold plus the rate of interest minus penalty in case of premature withdrawals. The interest earned will be deposited to your account. You can opt to either withdraw the interest or get it accumulated till maturity. So your maturity proceeds will be equal to the value of gold calculated at the market price plus the interest accumulated. You can also opt to get the maturity proceeds in the form of physical gold, but the interest accrued will only be paid in cash. Also, if you want to take physical delivery of gold, then you will need to pay a charge of 0.2% on the redemption value. While in case of premature withdrawals, the proceeds will only be paid in cash. The bank will deduct a flat 1.5% on the value of gold deposited as handling charges, while 1% will be deducted as the commission of the bank. These will be calculated on the basis of value of gold at the time when the deposit was made. This is the cost of investing in this scheme. So you will not only earn interest on such gold, but will also not have to worry about the safety of gold. That's all for now from Why Not Mint Money. Thanks for watching.